Adam, we've got the Fed meeting coming up tomorrow. A lot of people seem to expect a pause, so maybe it goes more to the color in what's said. What are you going to be listening for?
Yeah, I expect that you're going to hear from the Fed a message that was in line with what Powell recently spoke about at the Economic Club of New York, where basically he acknowledged that financial conditions have tightened, essentially doing the work of the Fed, and therefore the need for an incremental rate hike is a lot less than before. He's not going to fully shut the door to it, but I think you're kind of seeing central banks in general, as Megan said, kind of become a little bit more benign, take a step back. You saw it with the ECB, you saw it a little bit with the BOJ, and I think you're going to see it with the Fed too, where they've reached everyone other than the BOJ. Policy hikes are largely finished at this point in time. No one is thinking about cutting at this point. Balance sheets continue to shrink, but they're done hiking, and now they're going to just sit back and wait to see how inflation evolves from here. But I suspect that to the extent that Powell's speech from the Economic Club is codified in the official statement and during the press conference tomorrow, that will be welcomed by stocks, especially given what's happened over the last couple of weeks.
Yeah, Megan, you're still overweight fixed income and cash. How far do equities have to fall before you start licking your chops there?
Yeah, well, we are actually pretty constructive on the economy and expecting us to have a soft landing. And if we do see inflation continue to slow and economic activity slow, but not overshoot to the downside, I think it could be a very favorable environment for equities, especially U.S. large cap. And so I think, a 10% correction is pretty nice. Valuations for the overall index, when you strip out mega cap tech, are not too demanding. So I really don't think it takes too much further, but there are a lot of geopolitical risks. And the technicals on both the fixed income side as well as the equity side are not terribly favorable right now. So I think patience is okay, but waiting maybe for a little bit more weakness in the equity market to deploy some of that cash is what we're looking to do.
Okay, and Adam, today real estate as a sector in the S&P did particularly well. How long can that go on? How are you feeling about that and a couple of other sectors, even say financials right now, which also did well, but has been having a rough time?
Yeah, I think for real estate, you kind of have to be more specific about the various different subgroups. I think, the office market is still experiencing a lot of challenges, even though you have seen increases in return to work statistics. Retail REITs are holding in relatively well. Simon Property had a pretty strong day today, decent results out of that company. Home builders, perversely have benefited enormously from rate hikes, as that took so much existing home inventory out of the market. But that might be kind of nearing its end run. You've seen home builders trade pretty poorly of late, as the recent round of rate hikes is likely going to catch up to that entire market. So I think for real estate overall, it's going to be specific to the end market. Banks have not traded well over the course of the Q3 earnings season. The larger cap money center banks had decent results. They have a lot more pricing power that helped their net interest income and net interest margins. But the smaller ones, they're really seeing they're at a peak or past their peak of net interest income as deposit pricing pressure really starts to weigh on some of those names.
Right. Megan, we've also seen the labor disputes starting to kind of sort themselves out. The UAW seems to have made out quite nicely. So on the one hand, that takes some risk off if that's getting resolved. But on the other, you got some costs that are really going to be sitting there for a number of companies. Do you feel like you've got your arms wrapped around the costs? Contessa Brewer was just talking about the culinary union, which has issues for some of the Vegas properties as well.
Yeah, I think the strikes have gotten a lot of headlines, and I think they are very critical for certain parts of the country and certain industries. At the aggregate level, I don't think they will move the needle too much. We actually got the employment cost index today, which is probably a broader look at labor cost and some of those key input costs, especially for service companies. And those were pretty much bang in line. And I don't think that we're looking at any sort of concerning upward pressure on wages. And if companies are able to utilize technology to generate a little bit of productivity, that's not necessarily a bad thing for inflation either. So looking at the input costs is definitely important. I think the strikes getting resolved, some resolution in Washington, taking some of those risks off the table is definitely a good thing for investor sentiment and consumer sentiment. And going forward, it's really going to be about the inflation data.